Good morning, everyone. There you go. Thanks for joining us. We really want to get into the heart of this conversation. I want to thank New York for making me feel at home. Smell of weed on the street and folks fighting in Times Square reminds me a lot of Michigan Avenue in Chicago. So thank you for that. Had a great time last night. Got to see the Book of Mormon. Nobody prepared me for that, so thanks again. But I'm with U.S. Bank. I'm based right out of Chicago. I spent the last 10 years with U.S. Bank helping folks understand and enter the ETF space with many of you in this room, as well as my two friends on the stage with me today. So we're going to cover a variety of topics after we get a chance to introduce ourselves and really focus in on three of them when it comes to new to market. And that would be the trust structure, and I'll preface that by saying we're really going to focus on the 1940 Act ETF space today, and from the trust structure down to what it means to be an advisor and what it means to be a sub-advisor or a trading sub-advisor, for lack of a better term. And then also talk a little bit more in depth with Chris about the role of capital markets and why that's so important to folks entering the ETF space. So with that said, I'll go to Eric first, let him introduce himself and his company, and then pass it to Chris, and then we'll come back and dive right into these topics.
Great, thanks, Mike. So my name is Eric Falkhuis. I'm a co-founder and chief growth officer at a company called Title Financial Group. What we do there, we're a fiduciary agnostic platform for institutions and entrepreneurs to launch ETFs on. So what does that mean? Obviously, you've heard of white label providers in the space that provide the compliance, the infrastructure, the trust operations. We do that, but then we also do what's called sub-advisory work or portfolio management of the ETF, which includes tax optimization. And then we go a step further if that's something that you'd like to do, and we actually do marketing and distribution and national accounts for ETFs as well. We started this platform about 4 years ago. We have 40 ETFs on the platform right now and 2 trusts. We use U.S. Bank for a lot of our back office operations, and also Chris as well on the market making side, and others. And we're looking to double next year, just touching a little bit on the growth of the ETF industry, launching another 40 next year to get to 80.
Thank you. And so I'm Chris Hempstead. I cut my teeth in my early days of ETFs on the floor of the American Stock Exchange with some of my colleagues here in the room as specialists in ETFs before Reg NMS and decimalization. And after that, that second half of the of our careers shifted largely into capital markets and education, because the trading and secondary market infrastructure to support ETFs became very automated and programmatic. So as important as it is, teaching advisors and managers how to navigate the secondary market has been something that we spend quite a bit of time on with the banks, with the new issuers, with existing issuers, with users of ETFs. There are no bad questions, and even I think after 10 or 15 years of explaining a lot of this stuff, it never tires. There's never a bad conversation. There's never a bad question, and never take for granted that people just might not be used to trading on the New York Stock Exchange or the NASDAQ or with wholesalers or things like that, and that's okay. So what we'll try to do today is encourage you to ask those questions and get comfortable with it, because once you are comfortable with it, there's 3,000 plus ETFs that you can choose from, and the world is your oyster.
Sure, thank you. And just want to say one other quick note. If there are any questions at any time during our conversation up here, please feel free to raise your hand. We'll definitely address it, and then we'll address any questions at the end also. So to really get to the heart of what we want to talk about today and utilize the expertise of Chris and Eric up here, I'm going to go through a couple topics pretty quickly, and then we're going to focus on the main 3 that we talked about. If we start really quickly to focus on new to market and what are the pathways and what are the nuances around it, if we start with the term Rule 6C11, many people are familiar with that. I think the highlight of this one is to realize that there was a time, of course, in the industry when you needed exemptive relief to launch a fund. With the passage of Rule 6C11, for anything that was fully transparent, that did away with that. And second to that, you're familiar with the terms fully transparent, semi-transparent, and non-transparent. So if you move away from the fully transparent and away from 6C11, you will still be faced with the need to file for exemptive relief. Once we get in past that category and you understand what you want to tackle under the 40 Act and what you want to launch, we talk about a trust, a 1940 Act trust. You'll hear it called a RIC many times, Regulated Investment Company. There's many forms. Folks can certainly go ahead and launch their own or create their own RIC, but you might have heard the term shared trust or series trust out in the industry. If you think of it, I guess, bifurcated, if you start your own trust, you might be labeled a prop trust. Eric can give a little bit more insight as to why they went that route and what the benefits are. A shared trust simply means multiple advisors under the 1940 Act sharing the same trust structure, i.e. the same board, the same officers, and many times the same service providers underneath that, in order to gain operational and cost efficiencies. So going fairly fast on this because I really do want to get to the important things. And that brings us to our first category. What does it mean to be an advisor under the 40 Act? Eric will talk a little bit more about that. We hear the term sub-advisor many times in the ETF space. It's really, really important to understand that traditionally when the term sub-advisor comes up, folks will think about the strategy provider. Well, today we're going to focus on a sub-advisor as a trading manager during the day. Eric has a firm, within a firm, so to speak, that helps with that. And of course, that's really integral to the role Chris plays in the capital markets world and the expertise that his team will provide you should you try to tackle that yourself. We'll go right into there from, kind of segueing deeper into what capital markets does, what it means to be listed on an exchange, what the role of a lead market maker is and other liquidity providers. So that's a pretty quick overview. I skipped a bunch of other really important topics like sales and distribution. What does it mean? How do I get my product out there? And we also didn't talk about what's called, or we won't cover today what's called a 351 exchange or a mutual fund to ETF reorganization. Both all very relevant topics in the space today, especially when you're talking about new to market and your pathways to gain entry into it. So I'll put that 351 exchange and the reorganization from mutual fund to ETF on the back burner. Eric and I have had some experience with that, and again, capital markets does come into play. So we'll put that at the end and we'll try to cover that. But right out of the gate, I think I'm going to turn it over to Eric right now and talk about his service as both an advisor servicing people, but also as this trading sub-advisor entity, and then we can kick it back over to Chris to talk more in depth about how he interacts with both.
Yeah, perfect, thanks. So couple comments on trust structures too, just before I get into the advisory role. Trusts do have capacities as far as what a board can do with a fiduciary sleeve on it. And so I mentioned before we have two trusts. Our first trust did fill up, and it's both on a number of ETFs, but also a number of relationships as well. The way that our trusts are structured is we actually have a registered investment advisor, and we sit as the advisor of the trust, and our clients come in either as a sub-advisor or an index sponsor or an ETF sponsor. And so we do launch a significant amount of actively managed ETFs, so many of our clients come in as a sub-advisor. That would be different than what Mike provides with US Bank, where you would actually come in as the advisor in that capacity, and then if you were to utilize our trading group, we would come in as sub-advisor. So there is a distinction between both, and we'll get into that. So with our structure, we are the advisor. We have a significant amount of ETF experience. We think that has a lot of credence in what we do, and so we propose that we come in as the advisor, and then you would come in, or our clients would come in as the sub-advisor. So what does that mean? That means that we come in from an infrastructure standpoint, from a chief compliance officer standpoint, so we have a CCO at the advisor level and also at the trust level. And then we have a trading team of 5 individuals right now. That's all they do is tax optimization of the ETF, the compilations of the baskets, the custom baskets, the subscriptions and redemptions in kind that we work with Mike and his team at US Bank as the back office provider. There's a significant amount of work if you're coming from the mutual fund space or the hedge fund space or even an investment advisor with SMAs. There's a significant amount of experience needed to trade an ETF and what goes on a daily basis within the portfolio itself, but then also the interactions with the authorized participants.
Eric, can I ask a quick question? As you laid that out there, a question we get, and we will oftentimes get inbound requests for this kind of information from advisors who just aren't sure who to talk to. You know, like, hey, I'm thinking of launching an ETF on a strategy. They ask the questions, you know, how do I do it? And we'll tell them, like, if you go it alone, you're going to spend a lot of time and a lot of money, and it's okay, depending on what your target is and everything like that. A lot of time, a lot of money, take some risk, and that's a decision you have to make. Or you can join with someone like yourself. You know, the question I get is, well, how much do we save, like, by leveraging your infrastructure as it's already built, as opposed to going it alone? Like, what is it, a 50% factor? Is it a 75% factor? Like, what in general?
Yeah, I would say, and the way that we structure our business is it's your ETF. We don't have any title branded ETFs. We do take economic ownership in some of the ETFs now that we think will be pioneers in the space, and so we provide capital as far as economic partnership there. But we don't have any title branded ETFs, so it's your ETF that you come in. And like I mentioned, you can use a white label provider. You could use, you know, a provider like us that provides more services. You could go directly to a U.S. bank and be the advisor. It is a little more expensive to use a trust like ours. I'd probably say 10 to 15% more than if you went on your own. But you do have to take into consideration the time savings and the infrastructure that it will save. And also just, we recommend when we meet with clients that are new to the ETF space, you want to be with a team that you can rely on, because there are a lot of things that you haven't seen before, capital markets being a very large piece of that in what you do. And so we bring everybody together, all the industry experts, to help you in launch. But I'd say probably about 10 to 15%.
And that's in cost to the management fee.
In cost of the yeah.
Chris, did you want to talk about, you broached the subject of this trading sub-advisor relationship and how that's different from a strategy provider. I think maybe I can set up the next part of the conversation where you can maybe explain a little bit of the difference between what we call the primary and the secondary market. Generally, mutual funds exist in the primary market world where they're going to send, meaning shareholders of the mutual fund, are going to send us, the transfer agent, cash, and we're going to pass that on to the manager, and they invest that on behalf of the shareholders, and we are the record keeper. But of course, ETFs exist in the secondary market where you need a bid ask and you need a depth of book, and you also need a product that translates well into trading on the secondary market. Maybe you can spend a little time talking about square peg, round hole mentality of what fits and doesn't.
Yeah, there's a lot of things that get thrown around the room in these conversations. Most of you are familiar with it, but we don't want to assume that everyone is. So when you hear the words market maker, what is a market maker? A market maker can be a lot of different things. A market maker is oftentimes a liquidity provider, right? Not necessarily, but they often go together. Oftentimes, market makers and liquidity providers are also authorized participants, but they don't have to be. So there's a lot of confusing little connections. But if we try to just break it down and not have you understand all the nuances of it, the roles of the different participants in the market. So it's most important to remember that when you launch a product or you're looking to consume an ETF product, you're no longer shopping with the mutual fund company. You're going into the stock exchange, where the participants in that stock exchange are independent contractors. Okay, there are 7-Elevens and Wawas and whatever you want to call it, that sell 50 different brands of water. It's the same kind of thing. These are thousands of ETFs by hundreds of managers being represented on this storefront called the New York Stock Exchange or the CBOE or the NASDAQ. And they have people who are members of those exchanges who are willing to buy and sell all of the merchandise on that exchange, ETFs included. And in order to do that, they have sophisticated pricing algorithms and things like that to price it up, because it's an exchange-traded fund. It's open. So anytime there's excess demand, they can just sell as much of it as they need and then create it in the manufacturing facility as an authorized participant. That's it. They go out and gather all the ingredients, and they give it to the trust, and then they deliver the ETF out for settlement. And if there's excess supply, they come flooding the market with shares of the ETF. The market makers and liquidity providers will buy them in the secondary market. We'll take everything, and then they'll redeem it back to the trust, and they'll get the securities back, and they make them go away, and everybody's happy. And that's all it is. It's just ebb and flow of supply and demand, the market makers, liquidity providers, as authorized participants or with their authorized participants, create and redeem ETFs to meet all the supply and demand in the room. As a manager, you want nothing but inflows because you get paid on assets under management. As an independent contractor on an exchange, like we are, we want turnover. So whether that's all buys, all sells, or buys and sells, we like trading activity because the independent contractors on the exchange aren't required to buy or sell those ETF shares from those in demand or those with supply at net asset value like a mutual fund. We actually sell ETFs at a slight premium and buy ETFs at a slight discount. And we compete with many other very fast, sophisticated, low latency independent contractors. And the margins are very, very thin, and that's really good for the end consumer. And so you'll find that in the secondary market, people are always saying, well, we want tight spreads. Believe me, in almost every ETF, there are tight spreads. Spreads, what I mean by tight, doesn't have to be a penny wide. It's tight relative to the type of exposure you're getting in that ETF, right? And so when we came along, right, I've been in the business a long time. I've worked for some big market-making firms, and I've worked for a global bank. And then I took some time, and I was doing some consulting when the global bank got out of the equities business. Why would you get out of the equities business, right? But they did, right? And around the corner, I'm looking at them, I'm talking to my colleagues. I stayed in touch with everyone and said, what's going on? There's hundreds of ETFs coming to market. There's more and more demand for capital markets expertise. There's not enough market makers, there's not enough authorized participants and global portfolio trading desks to support all of the tax-efficient trading that the sub-advisor does or the liquidity in the secondary markets. And so when I came to Murray Asset Securities, they said, could we do something like that? And that's exactly what we set out to do. And more firms are coming to that independent marketplace and becoming authorized participants, becoming market makers, and offering themselves out there with their balance sheet to do rebalance trades and to supply ETFs where there's demand and buy ETFs where there's supply and educate all along the way. And believe me, we're going to go back to $7 trillion in AUM in the US, right? And forecasts are it's going to 20 trillion. So we're going to need twice as many market participants in that secondary marketplace as we have today, because there's going to be twice as many managers bringing products to market in the next 5 years after 6C11, which I thought when I first heard 6C11, it was a Star Wars thing. I was like, I didn't see the new one, and was that the new robot or something like that? But then I found out it's just a license to do whatever you want in ETFs, right?
Yeah, well, Chris makes a very good point on the market making side. We have a significant amount of clients that come to us. Let's just say a registered investment advisor that has 200 million of SMA and wants to move some of the smaller accounts into an ETF, and they have $10 million to seed, $15 million, and they say, let's go. There's a lot of work that's up front in talking to the market making community and the AP community to see, is this something. It's great, you have $10 million out of the gates, it's a good strategy, but will it survive in the ETF ecosystem? And to Chris's point, it's about volume, it's about trading in order to keep the spreads tighter and to have the market making community and the community look at it and say, I think this ETF is moving in the right direction and it's gaining traction and I want to invest in it. A significant amount of advisors will look at something that doesn't trade and say, it's not liquid. Well, it is liquid. If you look at the underlying portfolio, it's very liquid, but it's a whole perception of it being illiquid, not surviving. I'm not going to put my client's money into it and have it close down in a year.
It's chicken or the egg. Always chicken or the egg, analogy. So you launch an ETF, it's a great strategy, it's outperforming the bench, it's outperforming SPY. Why does everyone buy SPY? It's outperforming SPY, it's a better product. No one knows about yours, you didn't have a banner flying behind us here talking about it, so how do you get out there, how do you make it happen? If the spreads in the ETF are wide, you're gonna turn around and blame the independent contractors. You say, well, of course we're not successful because your spread is 10 cents wide or 15 cents wide and SPY is only a penny wide and we can't win in this marketplace. And so what we'll do is we'll work with the advisors and the sub-advisors. We'll say, all right, fine, we'll keep the market tight. We'll put up tight bids and offers, and we'll do that all the time. But just trust and know that you have to sell the ETF. It's not going to sell itself. You got to get out there and do it. And so we will support, as market makers, ETFs and try to keep the spreads visually happy. But liquidity, right, of an ETF is absolutely not defined by its average daily volume, right? It's defined by the quote. And I use the water example at Wawa or 7-Eleven, right? You go in there, there's 50 different brands to choose from. And if Conde West or whatever his name is comes in and says, I like Poland Spring, everyone's gonna go buy Poland Spring and they'll pay $1.50 a bottle for it. There might be another bottle of water for 99 cents that no one's buying because it's got a crappy label and no one cool is buying it, but it's 99 cents, it's water, it's the same thing. Is it liquid? Can you buy it? Is it fungible? Yeah, you can get it. But no one wants to buy it because they're chasing something else. So I will tell you right now, if you launch an ETF and it's not trading right away and you're not seeing the uptake, as long as the quote is okay, then sell it, right? You have to sell it. Now, what is it if you launch a successful ETF? You come to market, I'll pick on Strive for a second because they came to market, they did some massive advertising and digital campaign and TV campaign, and they launched this arguably controversial ETF, there was a little bit of story behind it, and it traded like crazy right out of the gate. Guess what they don't need? A lead market maker. Why? Because there's so much volume in the ETF right out of the gate that now they have 15 market makers that I could probably name on 3 hands that are in the box because there's volume. And what do? They're looking to capture arbitrage and buy it at a discount and sell it at a premium. And if there's volume there, they're going to all programmatically be trading that name. If there's no volume, you need that lead market maker. You need that 1 or 2, foot soldiers in the independent marketplace to say, I'll put your product on my shelf and I'll make it 99 cents all day long and make it available to all the consumers. And we'll do that because we have a bigger, deeper relationship with your organization, really. I mean, that's what it comes down to. If there's no relationship and there's no volume, you might have a hard time getting someone to put that product on the shelf at a good price. But if you have a relationship with these independent contractors, you'll get them to do it. If there's tons of volume, you don't even need them. There'll be plenty of people making markets in your ETF, and you don't need to worry about a thing.
Yeah, another example, we launched a rising rates ETF a little over a year ago, and it was struggling with volume, but they hung in there. So sometimes it just takes time. And sure enough, after 6 months, the performance was above the benchmark and above the peers. And I was on the phone daily with the CEO of our sub-advisor. Can you tighten the spreads? Can you call the market and tighten the spreads? Well, sure enough, it started taking off, and there was 10,000 shares a day, 20,000, 50,000 shares a day. I don't have conversations like that with their CEO anymore. It's more about how do we take it from 100 million to 400 million.
Yeah, and by the way, there's a couple, I mentioned before, there's different types of market makers and APs, liquidity providers. I used the word low latency earlier. There are firms out there that are heavily invested in technology and data, and I consider them low latency market makers because they can do 100,000 things in a second, and there's not a lot of firms that can do it, related to an ETF. There's other types of market makers like ourselves. It's the low latency, high frequency, if you will, trading environment is not really what Murray is built for, right? We have not invested in that big infrastructure, but we have invested in lead market making. And so what I will do, right, with part of our desk is we'll come out there when your product is new and it needs that market up there just while the product is growing and there's not 15 market makers in the box. We would step in, I call it like surrogate market making or market making light. And we take care of those younger ETFs or the ETFs in need because we have relationships with the manager. And when those ETFs grow up and they start trading like crazy, we call them up. We're like, you don't need us anymore. We're going to go ahead and pull out. Call us when you have a new ETF that needs help, and we'll shepherd it into the market, and we'll put a 2-way quote out there and until it starts trading like crazy, and then there's every market maker in the world is making it. And generally, when everyone starts making a market in a product, just so you know, it's forever. They don't really turn it off. It goes into a bot, and it doesn't get kicked out if the volume dries up. Generally, So there's 2 types of market makers you're dealing with. Some are, I'd say the top 2 or top 3 market makers probably provide, 60, 70% of the liquidity in the market in ETFs.
Oh, at this point, I was just going to get out of the way and let Chris and Eric.
We stopped.
No, that's okay. Pardon me. Any questions for any of the topics that we covered right now? I think that since the panel really is about new to market and pathways to market, we're starting to discuss AUM. And AUM is something that everybody loves, something that powers both sides of the equation on paying the bills as well as the perception in the marketplace. So Pardon me. Let's talk a little bit about what we might categorize as captive and captured AUM. As Eric mentioned, you can come to market with captive AUM that might be in the category of what we discussed as a latter bullet point of a 351 exchange, which is bringing SMA assets into an ETF wrapper. The other one is a mutual fund to ETF reorganization. So those captive assets allow you, number one, as a manager to retain them, but number two, also helps you come into the marketplace with, let's say, a success story. A lot of times folks don't look at where that AUM came from, they just look at the fact that it's in the ETF. If you want to go out and capture assets, you need a well thought out marketing plan, obviously. Just saying I want 0.01% of SPY is not a great plan. Yeah, you're going to need to present that to Chris, you're going to need to present that to Eric, should he represent you as advisor. But most importantly, and maybe you can talk a little bit about this, excuse me, having a plan to tell where that ETF fits in and how to use it and why it's important.
Yeah, absolutely. So we go through a heavy due diligence process before we launch an ETF, and not just on the operations side and the capital market side, but also the marketing and distribution side as well. So we bring in our marketing team, we bring our distribution team together and look at it and say, how can we differentiate this ETF from the ever-growing environment of ETFs, and how can we raise AUM? And also level set and set expectations with our client, because I was just talking to Jay Baker from ETC, having coffee. He calls it a daily grind. It is a daily grind. It's very difficult to raise assets in this type of environment. However, as you see, ETFs are ever so growing, because of the tax efficiency of it, the transparency. I think less so about the costs, but the costs as well. And it is the future of growth right now, or one component of growth. And so we go through this process. How I differentiate it, and I leave it up to the experts on our teams, but I break it out, at least in the beginning, is it a retail ETF or an institutional ETF? And those are two different types of strategies from a marketing and a distribution standpoint. Retail, thematic, something else in that regards, heavy marketing, heavy digital marketing to start awareness, maybe brand awareness, consistent drip campaigns, follow-up, and then the institutional side relies more on sales individuals, national accounts, consultants, and a retail can become an institutional, and an institutional can become a retail. But that's how I at least break it out in the beginning with our clients, and those are two different types of plans. And it really opens up their eyes as well. Obviously you want to raise AUM in your ETF, but what we're finding for a significant amount of, I'd say, hedge funds and also investment advisors, it's a diversifier of their business. It's a way for them. We've had people that have, investment advisors that have launched ETFs that have gotten big SMA accounts because they have a commingled product in the marketplace and a track record, even if it is 3 months old. So it can be a diversifier of business, but just in general standpoint, that's how we break it out. And we've put together a distribution and a marketing plan for at least 2 years for every ETF that we launch. And then we do checkpoints, obviously, based on that plan.
What we like to see on our side, when we seed an ETF or if we're involved with the manager, and I think a lot of people in general like to see steady and thematic growth of the ETF. It's nice to come to market and bring your assets and start with $50 million or $100 million, and maybe that gets you onto a big platform faster or sooner, and there's a fast-tracked aspect to that. But it's okay if you don't. You can come to market with an ETF with $1 million and of seed capital with one of your partners or your own money, and then go out and sell it. Because what looks better than coming to market with $50 million or $100 million and staying there for 2 years is incremental growth every single week, every single month. Pop. It's such a nicer looking story, than, we came with $50 million and we got on XYZ platform right out of the gate, and then it did nothing for us. But if you have organic growth and you're growing month over month over month, look at Innovator. Innovator came to market with very little seed on all of their buffer products, and they've had nothing but upward sloping growth since the day they launched. That's the story you want. That's what you want, I think, in a successful. That's what you want with your clients, and you'd hate to come to market with a big giant seed or bring your own assets and then have it just stand still for a while because then it's not really doing you many favors, right?
Yeah, it's a completely different environment than the mutual fund environment. I remember being in the mutual fund environment where you could launch a mutual fund and let it sit for 3 years and get a Morningstar rating and then take off. And in the ETF system, if you have a ETF that's been sitting for 2 or 3 years, it's most likely dead in the water, unless you want to completely subsidize it for a while, and you may take off at some point because of some macro environment change or some, some wishful thinking there.
It's worth noting if it's been dead in the water for a little bit, and then you figured something out, you have a eureka moment. I don't know, you work with Mike Cronin, and he helps you get a digital ad campaign out there, and all of a sudden, there's 50,000, inbound interest for your ETF. That's great. But do yourself a favor and let your advisor of the ETF or the market making community know that you're doing this kind of stuff. You don't have to tell them what's coming. Just say, hey, by the way, we're shifting gears. We're going to do things a little bit differently. We might see some interest. Or our PM is going on CNBC for the first time ever to talk about the product. Really important to give a heads up, because if your product's been doing nothing for 4 months straight and there's been this, very nice market maker out there making a market, couple thousand shares aside, and all of a sudden, out of nowhere at 11:38, there's 500 buy orders coming in. I'm telling you right now, the knee-jerk reaction is to pull from the market. Something must be wrong. I must have my pricing wrong. I'm going to get hurt. And that's the worst possible time to have your market maker out of the market, because that's when you have your first real buyers in the market. And what's going to happen if there's no market maker? They're going to pay $2 over fair value. They'll never get that money back. It'll take years for them to get that back in return. So really important, if you're doing things loud that you think are going to shake up the street and get assets, you're shaking that tree hard, make sure your liquidity providers are aware of it. They may not see anything, but just give them the chance to say, like, hey, this is actually good order flow, it's natural, it's non-toxic, and we probably have everything right, because the last thing in the world you want is your client having a bad price experience, because you'll never get them back.
Yeah, if we're doing a large PR campaign, for example, for one of our clients, we'll always talk to the market-making community about it. Any change in structure we do, like viewing what you do, Chris, as a partner is very, very important in launching and maintaining an ETF.
Yeah, we'll call them, but that 3 minutes or whatever it takes to get someone on the phone to say what's going on, during those 3 minutes, some people might get some bad prices, and you don't want that. So it's good to be ahead of it.
Great. So I guess we can go and maybe segue into something that you've already covered. Pardon me.
It's the weed.
In Times Square after Book of Mormon with the cast. So that was even more fun. So you talk about raising assets, and the SMA world is different, obviously, so is the mutual fund world. You step into a listed security here. You're under the purview of FINRA oversight. Many times your sales force might need to be Series 7 licensed. So there's a message that you can get out there, but you certainly have to do it in a compliant fashion. That brings you into the world of what a distributor is. We won't really unpack that too much. Distribution is different. I would call it, it's more passive on the ETF side than it is on the mutual fund side. There's certain rules and regulations that you have to follow. You have to get certain marketing materials approved by FINRA through your distributor. But that said, I can kick this back to Eric and then back to Chris, because believe it or not, there are certain things from a promotional standpoint that a desk like Chris can help you with in a compliant fashion. But also maybe you can talk a little bit about how you have to caution folks. It's not the Wild West. Once you're launched, you just can't say anything anytime you want.
Yeah, like I mentioned before, we're doing a lot of actively managed ETFs, but one of the trends that we're seeing now are social media influencers wanting to launch ETFs and use their followings for that. So that is a big education process on what they can post on social media, and also when and where to get it approved. And that's evolving too. You get different opinions from different statutory distributors as well on that. But the trend that we're seeing on some ETFs is heavy social media as a marketing and distribution force. And so it's a lot of education on that. Yeah.
I mean, from our standpoint, we generally we're always looking to see what's coming out and what's new. I don't know. I think it's easier and more fun to have stories with thematic stuff. Andrew Channon's in the room, I think, or maybe in the back room. I mean, he's for me a pioneer of thematic ETFs. Tells great stories. Seems to be ahead of the curve on a lot of stuff. Those are fun things to strike up conversations with. It's hard to strike up a conversation on, on diversified 60-40 strategies. It just is. There's a lot of stuff out there. But the thematic stuff, even though it's a very small part of the overall investment pie, in allocations, it's the most fun stuff to talk about. So, from our perspective, we don't really have as much risk on what we can and can't talk about, but we are in front of different clients, different types, not just managers, but users, RIAs and such. And so a lot of times we'll get on the phone and say, what are you thinking about for that 3% sleeve that you're looking to, find something interesting for, and that's usually where we'll go with it, and then we'll try to point them to the managers that fit that dialogue, and then our job is done. We've made an introduction.
We'll also use various stock exchanges will do marketing behind some ETFs as well, if they seem interested in that type at that moment. So we leverage, obviously, the market making community is instrumental because you have the relationships with many big institutions that can allocate, and also you do great research pieces that they put out, via email or sending through social media. But the stock exchanges can do things besides bell ringings as well. They'll do interviews with portfolio managers and use their social media outlets to disseminate the awareness for those ETFs. So leveraging partners, it's a good point. Leveraging partners where your sales team do not need to be licensed to mention the ETF is something that is instrumental in doing.
Can we mention Meet Kevin? Is he a social media influencer?
He's one of ours, yeah.
Right.
Yeah. He's one I've had a lot of conversations with about what you cannot do.
Any questions so far about what we've been discussing up here? Any questions about the play, Book of Mormon, weed, anything? We can cover it all. Yes, we have a question in the back.
Yeah, I have a quick question for Eric. How do you balance the different or the benefits of an actively managed fund that seems to be a big trend now with the tight spread benefits and issues that Chris was talking about? Because obviously it's hard to have both.
Yeah, it comes down, and we've had managers come to us with an actively managed portfolio where the basket that was launched was different than what they wanted to initially do from that. Using different securities, maybe some synthetic securities, for example, as part of the portfolio. It really comes down to the composition of the basket and how that can trade on the exchanges to get those various spreads that you're looking for. And capital markets, I can't stress enough how important it is to have the right people working with you, with the market making community on that. That could be the difference between a successful ETF and a non-successful ETF, people's experiences on buying the ETF at the different prices. If there are large trades that come through, you know that someone's going to allocate $1 million or $2 million to your actively managed ETF. There are ways to go to the desk directly and get those types of transactions done.
And from the market making perspective, and I'll speak for myself, and I think I probably speak for a lot of the market makers out there, the spread contribution to active management has been very hard to measure. And I mean, I can find plenty of active ETFs that are tighter than passive ETFs. And it comes down to the volume. Again, it's if there's a lot of volume, most people won't notice if it's active or passive. As long as there's participation, I can assure you that those highly advanced and highly invested market-making firms are going to be in the box, and you'd be shocked at what they can do with very little information that you see. We're active as an authorized participant in non-transparent ETFs. And so we're constantly getting asked, hey, could I do this and could I do that? And it's very hard for us. We can try to, figure out what's in the fund and try to figure out how to create a hedge basket. I can tell you that, I've not been as successful as at others at doing that, but I can tell you that the markets that we see on screen are very tight in non-transparent ETFs, in the active share sleeve. It's amazing. I think I got hurt in active years ago when I was a market maker at another firm. It was an active ETF. We didn't realize that we were perfectly hedged, at least we thought we were, and they had made a significant change to the portfolio from one day to another, and I was getting greedy. I said, well, I don't want to create or redeem until I have at least 500,000 shares, because there's economies to that. So instead of me spending $500 to create on 50,000 shares, I'll spend $500 to create on 500,000 shares. So I make a teeny bit more money. And in doing so, I carried risk over a couple of extra days. They rebalanced the portfolio. I didn't pick up on it. And all of a sudden, I'm long some biotech stock that's no longer in the index. And one day I said, why am I down, whatever thousands of dollars in this hedged position? I should be relatively flat. And we realized that, that name's gone. I called the issuer. I said, hey, what happened to that stock you were long? And they're like, yeah, we sold that the other day. I was like, what do you mean? And they're like, yeah, we're actively managed, dude. Like, we got out of it. I was like, well, I made that mistake once and I won't make it twice, right? So one thing we ask when we work with advisors like Title, if it's an active ETF, I can assure you as an AP or someone who's seeding an ETF or is interested in being a market maker, some of the questions we ask, how active are you? And you'd be shocked to know that most active managers said, we're really not that active, very low turnover, but there are some strategies out there that turn over every week, every day, but most of them are not that active. So what the portfolio we do see every night in a transparent fashion is usually very, very reliable for managing that risk. And their active behavior is generally, and a lot of times, predictable. Like, we kind of know when they trade. So if you sense that the active manager is going to be rebalancing because of a signal or something like that, you might go ahead and redeem and get a lot of that risk off your books so you're not carrying that unknown, risk. But I think in active, generally, the spreads have been really good, and they haven't been wider.
Yeah, there are things you can do too on the creation and redemption fee as well. You just want to make sure that those are fair, or sometimes you can waive them as well to help the market making community start volume as it goes. But to Chris's point, yeah, it's really the composition of the portfolio and the volume. The volume just, it solves that problem.
Any other quick questions on what we've covered so far? I think, yes, please.
Can you give examples of social media campaigns? You mentioned you're seeing more of that.
Sure. Pardon me.
Yeah, as far as like examples of ETFs that have launched, yeah, so a few ones. So Chris mentioned Meet Kevin. Meet Kevin's has a significant amount of followers on YouTube, and primarily based on financial advice. And so he wants to, and he's also in real estate, and he's done some other businesses too, but he wants to use that community to then create his own products, almost like as if it's a platform. We're about to launch them here soon, at least one of the 3 that he wants to do, so that we'll see how that works. We've also launched a social justice ETF as well a few years ago that's gaining traction. And while it's about a $400 million advisor, they're using social media as they're starting to get volume to really, really take that up, yeah.
There's another one. Have you ever heard of Motley Fool? So they're, social media, or I guess, and print. I don't even know if they do print anymore, but that's not a traditional distribution, avenue, right? They have subscribers, and then they're like, hey, well, we have subscribers, we give advice, let's launch an ETF, and they did, and they were very successful because they have a captive audience. And I think that's key. Dave Portnoy, didn't he launch an ETF? I mean, talk about social infrastructure.
I'm from Milwaukee. Giannis from the Milwaukee Bucks is going to launch an ETF with Calamos. I mean, people that have the social media presence now are understanding that they've made money on the social media side, and now they can translate that into the financial community through an ETF because of the way that they can take off with just catching awareness and moving.
You know, there's a K-pop ETF too. So I didn't know what K-pop was, and I work for a Korean company now. So I'm at Array, and then I get this call, and I'm like, oh, K-pop. I'm like, what? Okay, I don't know what that means. You know, it sounds illegal, right? And like, oh, K-pop ETF, and what is it? And so I get on the phone with these folks, and I get introduced to them through one of my colleagues who's Korean, and there's all these people on the phone that don't speak English, so I have a translator, and they're telling me about this great idea for this K-pop ETF, and they're selling me on the K-pop industry, which I did no idea what it is, but apparently it's a huge thing. And so they created an ETF of Korean K-pop companies, and it's listed. You know, it's not taking off, it's not crazy, but talk about social influence. You know, when I talked to them, I was like, well, why don't you just go to any country that'll let you do it? If you got 300,000 people in a crowd, just have everyone scan a barcode that buys them $25 of the ETF. You guys will be off to the races right away. I don't know if you could do that in the U.S., but you know. That's a social influence, it should be on paper, a social influence story. We'll see. We'll see what the K-pop industry does with it, but pretty exciting, right? I mean, yeah. K-pop.
Yeah. So I'm going to give this another shot. Thank you. I love ETFs so much, I get so emotional. And, no, my apologies. I have no idea, but I seem to find my voice. So we're getting towards the end, and I just thought maybe I would just kind of give a quick little recap. I think the overused cliche of simple but not easy really does apply in the ETF space. I think we can bifurcate it on the simple side. On the 1940X side, it's a pathway, and that pathway is well defined. And it's a simple pathway, and it's out there, and we've got the great resources to help you understand, should I do my own trust? Should I share a trust? Should I be my own advisor? Should I utilize Eric? What do I do when it comes to trading sub-advisory? Again, not the strategy. What do I do when it comes to selecting an exchange? Now we go into the not easy side of the equation, and that's sales and marketing, AUM gathering, interaction with the capital markets, and those items, again, they're out there, but they need a little bit more refinement prior to launching a product. So I think the best way for me probably to wrap it up would simply be to go back to Eric and go back to Chris. Maybe a simple or an easy question, I don't know, but what is maybe one or two things that you would caution people on the most, something that you've seen be the biggest stumbling block rather than the biggest success part of the equation?
Yeah, sure, thanks. I mean, what's good about the ETF industry as it stands right now, it's a really small community, and we all know each other, and it's a very respectful and professional community. So I would say with that, talk to one of us. I've referred business to Mike. Mike's referred business to me. We've referred business to competitors. It really is a good environment where people aren't going to take business that they don't think that they can help you. They'll push it to somebody else, probably because there's enough business to go around right now with all the ETFs that are being launched. Maybe that changes. Second, I would say we've stressed it, I think, enough here, understanding the capital markets piece of an ETF launch and success is extremely important. Can manage all the operational, compliance, financial just fine, but if it doesn't trade appropriately, it's going to be very difficult to raise AUM.
I would say that in addition to that, just trust and understand that from the trading and markets perspective and supporting an ETF as a market maker, a lead market maker, as an authorized participant, ourselves and the dozen or so other firms out there that are really good at it, we do this. We're programmatic. We've got it figured out. We want to hear your story. We want to develop a relationship with you. We know that folks like Title and some of their competitors, their peers, their friends are really good at managing that job that they do. At the end of the day, nobody makes money without assets. So you can have the greatest idea in the world, but without assets, you're making nothing. And so our job on trading in markets or on managing the structure of your ETF and making sure it operates smoothly and legally those are two of the easiest jobs because we do it all day, every day. The hardest job is raising assets. I hate to say it, it is the hardest job, and it's the one that oftentimes, people scratch their head on and are like, I don't understand, I did everything right. I got the best market maker and I got the best sub-advisor and we're not raising any assets. These things need to be sold. You can get lucky, right? It happens. There are some ETFs that come out just at the right time. You know, it's just luck. You can't bet your future on luck. You know, it's nice if you do launch an ETF and it gets lucky, but 99% of them have to be sold and sold hard. So keep that in mind.
So I want to thank everyone for bearing with me, my voice problems. I guarantee you it was not weed. I mean, look at me. So, but
I've
most
known Mike for a while. It's not weed.
most importantly, I want to thank Chris and Eric for taking the time to be with us today. And in the short time that we had, we hope that you learned a little bit more about the pathway to new to ETFs. So please, if we can help in any other way, we're always available. Thank you very much for your time. Appreciate it very much.